Things are quickly evolving in the American political landscape, and although this channel is dedicated to finance and economics, it does go without saying that politics and economics are inextricably connected. And with the confirmation of Russell Vought, now as of being a few weeks old, he is one of the project authors of Project 2025, which is a mashup of authors commenting on policy recommendations for the new political regime that has been largely associated with far right and religious groups, such as the Heritage Foundation. And Russell Vought has been confirmed for the director of the OMB. So I feel like this is a good time to cover this today. Aside from Russell Vaught's confirmation, there are a list of policies proposed in Project 2025 that seem to be in the process of implementation, such as removing the departments related to education and the Consumer Financial Protection Bureau, favoring fossil fuels, and phasing out climate change deterrence, which they refer to as radical policies, eliminating funding for contraception, and this is both domestic and abroad, terminating DEI, and even making the language itself illegal. We saw something like this at the beginning of the month. Even making the language itself illegal. So we saw this at the beginning of the month with the CDC ruling the use of gendered language to be removed from all scientific articles in the database, which I think is hugely problematic for a number of reasons, but we're not going to cover that today. There's also the mention of Trump within the Project 2025 handbook about several hundred times. And of course, now ordering the dependence of many independent organizations on the government, which I think is going to undermine the American economy over the next few years. And also is something that I believe will require a full video sooner or later. So today, we're going to go over a critique of Project 2025's economic policies and weigh out if they are beneficial to the broad economy or not. Unfortunately, this is a very lengthy document, and because of the mashup of authors associated with this, it's pretty unfocused. So we're only going to go through the policies related to the Federal Reserve in detail. I will mention some others that do stand out, but generally speaking, I think that the Project 2025 handbook with respect to economic policies is a mixed bag with negative skew. Authors themselves are probably smart people. Many of them are PhD economists. And I think that the overall rationale and reasoning and evidence is mostly positive. A lot of the conclusions drawn, I think, are misleading. So we're going to discuss that today. So again, we're just going to be talking about the representations for the Federal Reserve in detail, and these are just presenting in the reading order, by the way. So the first one is to eliminate full employment from the Fed's mandate, requiring it to focus on price stability alone. So to be honest, I just don't think that the arguments embedded in the handbook are compelling enough to really draw this conclusion. There hasn't been a good explanation for why it would interfere with the central bank's operations or why it would necessitate inflated money supply, as opposed to, say, the normal operations of the central bank related to its reserve requirements or, for example, its open market operations that are not related to unemployment. Additionally, unemployment typically goes hand in hand with the intervention of monetary policies because lower interest rates will lead to cheaper business loans and therefore greater business expansions, and those typically lend to lower unemployment. This could be moved to the goals of fiscal policy, but the idea that fiscal policy is going to be able to fully capture the effects of monetary policies in the short term is probably naive, given that there's numerous lags implicit in government intervention that makes short-term intervention by fiscal policy or changes in tax rates unfeasible. Second, Have elected officials compel the Fed to specify its target range for inflation and inform the public of a concrete intended growth path. There should be no more flexible average inflation targeting, which amounts to ex post justification for bad policy. So, although the central bank does use flexible average inflation targeting and it does introduce some uncertainty, it's pretty relatively clear, at least, what the inflation target is. It's typically going to be about 2% annually, give or take. So, with that in mind, we kind of already know which direction the monetary policy is typically going to be moving, broadly speaking. Additionally, the Fed communicates its intentions for the Fed fund rates through the Federal Open Market Committee, or the FMOC, in which it provides forward guidance on interest rates and inflation targeting. So I'm not completely opposed to the idea that the growth path should be transparent. However, but this is clearly an oversimplification of the issue. We should try to limit government intervention in monetary policy as much as possible, which is something the author mentions. However, they write it as though it were certain that the central bank must monetize government debt when its very function and trust depends on it not doing so. So, in other words, the other jurisdictions will not, or sorry, other regions will not have trust in the US's economic institutions if they are politically biased and would do things such as monetize or pay off, so to speak, government debt. Um, so for their functioning, they can't really do this. So I don't think it's convincing enough that they would necessarily monetize government debt. But it's not feasible for them to do so. And if they did, then the US economy would not be in the solid state that it is today. Additionally, the central bank must respond to ever changing macroeconomic conditions. So if we took a inflexible inflation target, I just don't think that would really make sense with the dynamics of the market. And if they did, I mean, would the author find themselves writing stuff such as deviations from its rigid inflation targeting shows how ineffective and stochastic monetary policy is? Um, and additionally, the central bank only really intervenes in market booms or inflation, when inflation increases and starts to heat up, as the economy starts to overheat. And again, I don't have time to explain everything in this video. We might make a video in the future explaining some of these things in more depth. But would the author like the central bank to reduce the peak of otherwise healthy market booms? Maybe not. So I don't really think it makes sense for the central bank necessarily to operate from a very static position on inflation targeting, because they do need to take account of the economic context. Third, focus any regulatory activities on maintaining bank capital adequacy. Elected officials must clamp down on the Fed's incorporation of environmental, social, and governance factors into its mandate, including by amending its financial stability mandate. Okay, so number one, there's already some sets of regulations, such as Basel III, which emphasize, in no small part, capital adequacy, right? Now, that's not the sole focus of it. When you look at the CAMELS factors, it does include as well asset quality, management, earnings, liquidity, and sensitivity to market risk, which are also important. These aren't things that have been incorporated into the regulatory framework for no reason. Additionally, discussing two other ideas. The first, that politicians are going to intervene with the central bank operations, is going to potentiate the dependence of the two that was problematic for the aforementioned reasons. And two, although the criticism is that ESG factors are being used politically, which may be true, that ESG factors cannot or should not be incorporated into the financial markets is simply wrong. So to give you a few examples, talking on the numerous environmental issues that could be harming businesses over the long term, and which are expected to increase, assuming that the author is not a climate change denier. There are some potential uncertainties associated with climate change going forward. Now, namely related to the release of carbon via carbon sinks. That's a little bit unclear, but talking about some of the ways that environmental factors could be impacting businesses going forward. For example, if you are on a coastline and you are more susceptible to flooding, well, you may now have to spend more in terms of drainage pipes and other infrastructure to prevent that. You may be more susceptible to the hurricanes, for example. The incidence of hurricanes may increase and also cause infrastructure damage. It's going to increase the cost for your insurance companies and also for the cost, therefore, of you to pay out insurance. Just as a few examples of environmental factors that need to be considered. Now, there's also social and governance factors aside from DEI. I know that they focus a lot on DEI and woke policies in this mandate, but that's not the only use of social and governance factors. So, for example, they're going to include things like management experience, employee satisfaction, and other things that are just important at face value, so to speak. And this all kind of is used to explain why, I guess, economics should not be governed by politicians. Okay, the fourth, curb the Fed's excessive last resort lending practices. These practices are directly responsible for too big to fail and the institutionalization of moral hazard in our financial system. Okay, so actually, this is sort of true. So there are other regulations acting on the financial institutions that help. However, it is also the case that they are literally too big to fail, in that financial institutions do have great systemic importance. So if one bank fails, that can typically cause a cascading effect down the line, and this can even go as far to cause financial contagion across the border. So, although it's likely a better idea to limit lending through increased regulations on the financial institutions, and keep in mind that this would require increased regulations, not decreased regulations, which I think is sort of incompatible with what they're advising overall here. And incentivizing them to improve things such as capital adequacy ratios, but in addition to the other CAMELS factors, both things that Basel III did post 2008. Not bailing out the big banks, however, may result in much worse financial conditions for the market, however, than not, which is an important thing to mention. If we don't, then that could result in much worse downturns. For example, if we think about the way that the Great Depression worked, which was effectively to, for bank runs to bankrupt the banks. That caused massive issues for the economy. Obviously, we're talking about the Great Depression. And when you think about 2008, one of the things that Robert Shiller had said about this, professor of finance at Yale, he said that 2008 was starting to look a lot like the Great Depression. And I would not doubt that not utilizing quantitative easing in the Federal Reserve's open market operations would have resulted in the default of these banks en masse and caused much worse financial problems. For example, you may find it difficult to get funding for your businesses. You may find that your assets are now gone. And in addition, foreign investment will be affected as, once again, other countries will no longer have trust in your financial institutions. Okay, 5. Appoint a commission to explore the mission of the Federal Reserve, alternatives to the Federal Reserve, and the nation's financial regulatory apparatus. Once again, partisanship would be bad. It is worth noting that the alternatives that they actually propose in the handbook are not really feasible, and the author does note this. So, for example, gold may provide more anchor and simplicity, which isn't necessarily a good thing, by the way, but it's obviously too inflexible for the needs of modern economic system. This is also an issue with the Taylor rule that they also potentially propose. The Taylor rule takes account of only inflation and GDP growth, or the output gap, effectively, as another example. these aren't really going to be feasible alternatives. So if you are proposing that the central bank should be replaced, so to speak, or the Federal Reserve should be replaced, I think you should come in within a better alternative, and they just haven't done that here. Okay. Prevent the institution of a central bank digital currency. A central bank digital currency would provide unprecedented surveillance and potential control of financial transactions without providing added benefits available through existing technologies. So it's a little bit unclear on what exactly they mean by unprecedented surveillance. There are electronic ledgers that already do exist. So, and in addition, there's not really an argument in this chapter related to this aside from this final policy recommendation. Um, I believe he is referring to keeping crypto decentralized. And in which case, I think that all he's really done with a lot of the arguments has provided a compelling case for why free banking would fail. So there's a number of problems that have arose as a result of cryptocurrencies, such as unprecedented financial fraud and otherwise illegal market manipulation, which many people are familiar about today. Familiar with today. It's guessing, but I believe that this proposal is primarily governed by the new regulations are bad movement. And perhaps this is also the result of the crypto investors coming out and saying things like the government has debanked us for no reason. And from my knowledge, the government has only ever done that because they were breaking the law. Okay, now talking about some of the other proposals from other chapters now. So that was kind of all the stuff on the Federal Reserve and criticizing that. From some other chapters, we see the implementation of the recommendation of a two-tiered flat tax, of which I would have to give them the benefit of the doubt. And again, they didn't stipulate this, but I'm assuming that with the two-tiered flat tax, they don't literally mean a system that would disproportionately affect earners in the 150 to 182K income bracket, because that would be completely careless, although that hasn't been stipulated. They also argue that corporate tax is the most harmful tax because capital is more mobile than labor, which, while is true, is another example of presenting an incomplete argument, I feel. It does ignore other case facts, such as the diminishing marginal returns that ought to be taken account of, that capital mobility is not perfect, that taxes are paid after operating costs, that investment expenses are tax deductible, that there are other reasons for businesses to conduct business in the US aside from just tax purposes. And it doesn't really do anything to distinguish corporate taxes from other kinds of taxes either. Just saying that capital is more mobile than labor. So I don't think that this is an argument that can isolate corporate taxes as the most harmful tax. And they also urge that regulatory bodies partake in identity politics, despite lacking any evidence for those claims. And arguably, there is existing evidence for the contrary, such as legitimate fraud, which I mentioned earlier, and this does hurt the financial markets. So, in summary, I know we covered a lot. Most of that was related to the Federal Reserve. Hopefully you found this video informative, but in summary, Project 2025 does not provide sound economic policy. All right, take care. Do you want me to say like and subscribe? Please like and subscribe. Okay, take care.